question is this: is Japan's weak yen story now moving from exporters and consumers into the financial sector? That is the change from yesterday. Yesterday, the market was focused on the consumer side of the weak yen. The Nikkei was higher, dollar yen was near 162, and the question was whether wage gains could absorb the inflation pressure that a weak currency can create. Today, dollar yen is still high, near 162.3, but the equity response is less convincing. The Nikkei was almost flat, down 0.009%, while TOPIX fell 0.827%. That is not a market break, but it does tell us the weak yen trade is not getting the same clean equity confirmation. The news flow explains why. The top stories are still concentrated in foreign exchange. One story highlighted Japanese asset managers pursuing global investor mandates as demand for yen bonds grows. Another framed yen weakness as part of a broader debate about Japan's debt burden. Reuters also focused on Japan's FX messaging and the continuing risk that currency officials could intervene. Put those together, and the yen is no longer just a currency chart. It is becoming a test of Japan's financial credibility. On one side, a weak yen and higher Japanese yields can attract global attention. Investors who ignored yen assets for years are now looking again at Japanese bonds, hedging costs, and mandates run by Japanese financial firms. On the other side, the same weak yen keeps officials on alert. If the currency falls too quickly, intervention risk rises. If investors begin to treat yen weakness as a debt confidence problem, the market's tone can change quickly. That is why today's equity move matters. The Nikkei did not collapse, but TOPIX weakness suggests investors are not simply buying Japan across the board. The market is becoming more selective. It wants to know which companies benefit from volatility and capital flows, and which companies are exposed to policy risk. Today's stock to watch is Nomura. Nomura is useful because it sits directly inside this tension. It is not just an exporter that benefits from currency translation. It is a financial firm that can benefit if Japan becomes more active for global investors. More bond demand, more trading, more hedging, more cross-border mandates, and more corporate activity can all matter for Nomura. Recent reporting has pointed to stronger momentum in Nomura's investment banking and markets businesses. It has also highlighted the firm's effort to build more stable fee-based revenue through wealth and asset management. That makes Nomura a cleaner lens for today than another manufacturer. If yen volatility stays orderly, Nomura can potentially monetize the activity. Trading desks get more client flow. Investment banking can benefit from Japan's corporate activity. Asset management can benefit if global investors want more exposure to yen assets. But the risk is not small. If the yen move becomes disorderly, the story changes from opportunity to policy shock. Intervention risk can hit positioning. Higher bond volatility can make investors more cautious. And if debt concerns become the dominant narrative, financial stocks can be pulled into a broader risk discount. So Nomura gives us a direct test of today's question. Can Japan's financial sector turn a stressful currency backdrop into revenue? Or does that same stress become too unstable for investors to reward? The next signals are dollar yen, Japanese bond demand, and TOPIX breadth. If dollar yen stays high but bond demand is firm and financial stocks hold up, the market is saying Japan's weak yen problem can still be converted into capital market activity. If dollar yen accelerates and TOPIX keeps lagging, the message is different. It would mean intervention risk and credibility concerns are starting to overwhelm the opportunity. For now, Japan's market is not giving a simple answer. The weak yen is still important, but the question has changed. It is no longer only whether the currency helps exporters or hurts consumers. It is whether Japan can attract global